Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your national underwriter for Old Capital, Paul Peebles. And joining me today is Les Meisel with Old Capital. Les, how are you?
Fine. How are you today, Paul?
I'm doing good. Hey, listen, before we jump into Joey's podcast, which I think you'll find fascinating because Joe has purchased a multifamily property on his own. Most of the time people buy properties, multifamily properties, in the name of a partnership or a small syndicate. But Joe has done it by himself. He's still in the IT business, and he wanted to buy the property with him. So I think he's going to tell a fascinating story about how he did that. But before we listen to Joe's presentation, I wanted to kind of visit with Les about what's going on the debt side. Les?
Paul, we're seeing our clients are having a lot of options in front of them right now because of the increased value of their properties that we've all been able to see over the last couple of years. The options are wide and full range, and they're being very sophisticated about how they move forward and what to do next.
So tell me specifically, what are you working on?
Well, working with a client that we met maybe about a month ago, a little over a month ago, that had a pending maturity, was contemplating either selling the property or just kind of going and refinancing it. And as we sat down and talked, realized that they were in a submarket that was improving greatly around them. And instead of selling the property, chose to rehab it and getting some cash out of during that new note. But instead of taking cash out, putting that money back into the property, improving some of the amenities, fixing up some of the deferred maintenance, but really getting the property value up in an equal basis with the market around them, allowing them to increase rates and improve cash flow.
Yeah, because if he had not rehabbed the property, he would not have gotten max dollars out of the sale. So it was better for him to have a little bit of a short-term pain to have a long-term gain. And so with Les and his help with one of our local regional banks, they took the cash out, put it into the property, solved some of that deferred maintenance issues, is going to push the NOI higher, and then probably about 6 months to a year, he's going to be able to sell it at a much higher price. Anything more you want to add to that?
No, we have a very happy client and hopefully closing in a week.
All right, sounds good. Thanks, Les.
Thank you, Paul.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, your national underwriter at Old Capital. Joining me today is Mike Becker.
Hey, Paul.
Mike, we have in the podcast today Joe Joy. Joe is a new multifamily owner. He's owned a property a little bit less than a year. And he tells a very interesting story. He bought a multifamily property by himself. He had no other investors on the property. He kind of found it. He did all the investing, put a loan in his name. And I want to visit a little bit with Joe. So Joe, let's have you meet everybody. Everybody say hello to Joe.
Hello, everyone.
So Joe, tell us a little bit about your background. What do you do right now? What did you do in the past? And let's visit and get to know Joe a little bit more.
Yeah, my background has been in information technology. I was the CIO for a company, healthcare company, for, the last 8 years. And very early last year, about a year ago at this time, I left the company I was working for. And at that point in time, I had just started looking at multifamily. I've been in single family for quite a while, but I figured it was time for me to move along to multifamily.
And how many single family properties did you have?
I had 9 single family properties. And then right about that time, I'd actually bought a couple 4plexes and a 6plex. And, a little bit different than, your single family. And then I decided, well, it was really time to move up. So that's when I started looking at these larger properties. I joined an investor club. And what came about with that was really better contacts and, having a mentor that helped me look at a property. So it was kind of interesting. The property that I did purchase, which is a 74-unit apartment complex in Hearst, they had actually had that for another investor, And I kind of came along to shadow to say, hey, let's look through the process and understand the process. And through a series of events, they decided that that was not the property for them. I'm not even sure exactly why it fell out. But I was able to then jump in pretty quickly and say, yeah, you know what? It looks pretty good, so let's go. So I started, really doing the due diligence and looking at that. And all the financials and everything looked really good. So it was interesting. The day we did the inspection was actually, after leaving the company I was at, I did start to do some consulting work. And I started a consulting gig on that exact same day. So first day I had to kind of take off to walk through all the units and all of that. So it was quite a struggle starting a brand new job at the same time I'm trying to close this first property. But honestly, Paul, along with yourself and with the Investor Club, my mentor and everything, honestly, it was slightly more work than buying a single family property. It was not all that much more difficult, which actually kind of surprised me, but I was, pleasantly surprised.
So it's kind of taking a step back. So why did you want to transition out of single family and go into multifamily? What was the reasoning or thought process behind that for you?
I call it leverage and also time. I think if you really look at investing in almost any job, one of the most invaluable thing you have is your time. And, working on lots of single family properties takes a lot of time. Working on a multifamily takes about the same time, but it's just exponentially better for you to invest your money. And I started looking at property that would support full-time maintenance person, a full-time, office manager. And so quite honestly, I spend as much time, maybe a little bit more on this property as we're going through some of the capital improvements that we're doing. But beyond that, I spend as much time really on the multifamily as I do, the single family. But I'm getting, rent from 74 units rather than, one.
Sure. So when you're looking at this property that you bought in Hearst, what was the target? What were you trying to buy when you were looking for a property? What was appealing about this property for you?
In the first property, I was not looking for, all right, let's go in somewhere that's the real big fixer-upper where you have to, put some money in and, really work at it. And, the long run, you can make some very decent money on it. I was looking for one that was fairly stable, that had sort of a good cash flow to it, pretty much day one, but still needed a little bit of work. And this property, fit the bill perfectly. So it needed a little bit of work, nothing that I will say major paint, some carpentry work. We're upgrading some of the units, which are working out really well because obviously that helps to increase the rent as the units become available. But nothing major.
Paint a picture for somebody that's listening to this. You talk about 74 units. Was it a pitch roof, flat roof? It was interior hallways, exterior hallways. What year was the property built? Is it a two-pipe chiller? Is it a boiler? Tell us a little bit about the property itself, the physical.
It is a pitch roof. It does have, the chiller. There are some internal hallways. There's some external. There's actually, I think, 8 buildings, 3 on one side of the street and 5 on the other side. The units vary from, a 1-bedroom, 1-bath all the way up to, a 3-bedroom, 2-bath, sort of 2-story unit. It is not individually metered, so all the, electric, water, and all that comes in, but we have a rub.
And what is a rub? What does that mean?
It means that we can take the expense that we have for the utilities and then allocate those based upon the different units to the units to actually pay back the utility expense.
Tell me a little bit about, is the property, you said it's big enough to have a manager on the property. Do you have a manager on the property, and do you have a maintenance person on the property too?
Yes, we have both. I actually worked with a property management company who really helped from day one, helped put together a pro forma. We kind of walked through it quite a bit. And actually, in some ways, it was very helpful with my previous experience, working with budgets, to be able to do the same thing here. You put together a pro forma, what, expected expenses, what we think rent's going to be, how we're going to be able to, increase the rents, all of that kind of stuff.
You never thought about trying to do it yourself and becoming the property manager. You You have a full-time job. You don't need another full-time job?
That's correct. It doesn't make sense in this type of a property to try to property management it yourself.
So some of the things I heard is that you wanted a property that was stabilized to some extent, needed some additional TLC, some tender love and care to the property, that was going to need to be managed by, say, a third party. Then you could have the manager on the property and a maintenance person on the property, being overseen by the management company. And then you're the asset manager, so you're managing the management company on the property. And now do you get monthly statements, quarterly statements from the management company?
Yeah, I get primarily the monthly statements and then quarterly statements, and then I actually got the year-end statement as well. But I also get throughout the week a daily report as well that they put together, just kind of quick little status, with your occupancy, what's going on, number of calls, any sort of maintenance work that gets done.
Wow.
And quite honestly, it's a daily report that probably comes out 3 days a week, which is perfect. It really takes me about maybe a minute to look at those. And quite frankly, if I missed a bunch, it's not really a big deal.
So this property is in Hurst, Texas. And Hurst is, how big do you think Hurst is? 50,000?
I was going to say 45, something like
50,000 people. So it's a suburban property in a suburb of the Dallas-Fort Worth area, kind of in the middle. So Fort Worth being on the left-hand side, Dallas being on the right-hand side, and the DFW airport in the center. This is on the west side of the DFW airport. So it's a good area, stabilized property, stabilized neighborhood. What would you think the average homes are costing in that area?
I honestly
Probably about 140 to 155.
That's what I would guess. Somewhere
$55,000,
about
$160,000. And what are your rents right now?
Really, they range from, I think our average rent is about $750, maybe all the way up to $795.
So $795 just for the rent, and then additional, you mentioned the RUBS, so you bill back to them some of the utility expenses that you would typically pay for if you didn't have that RUB expense in the works. Yeah. So tell us a little bit about, again, how did you find this property, and would you characterize right now is the inventory, when you went out to go take a look at the properties in the area, is there a lot of inventory? Is it light inventory? Is there no inventory of apartments? And again, how long did it take you to find this property?
It's kind of hard because I'm fairly new at this to say, what's kind of normal and not normal. But I really see pretty much, it's interesting. Once I bought this property, then all of a sudden I've gotten emails and calls from everybody that's selling multi-properties.
Yeah, you're the prettiest girl at the prom now.
Right. And so I would say every week there's 2 or 3 properties, new ones that come my way to say, hey, check this one out, check that one out. So there's definitely a nice flow to the different properties. What's interesting on this property, it was brought to me by my investor club mentor. And again, like I said, it was really, hey, you know what? I know you. I had met with them 10 days earlier. We talked about what I would be looking for. We really worked quite a bit about what would make sense for me. And he really helped me try to understand kind of what makes sense out there. And I think it was not even 10 days later, he said, hey, we're going to go look at a property. Why don't you come with me? I'll show you what I look for, and we'll walk through, the different property. And so this property really kind of came into my lap, and it took 10 days for me to say, okay, I want to start looking for something, to actually having something. It was probably another 6 or 7 days after that where it's like, hey, guess what? The other guy's not deciding to move forward. Do you want to jump in? So it happened very quickly.
Sure. So now that you have one underneath your belt, what are kind of your other aspirations as far as you out there targeting more properties, or you kind of standing pat for a while? I believe you also actually invest passively in a couple other people's deals as well. Maybe talk a little bit about that.
Yeah, I have 2 others that I'm currently an investor on. One is a nice apartment complex out in Denton, Texas, which is, north of Texas. 184 units, I believe. Very stable. It's interesting. They put together a budget and said, this is what we're thinking from a pro forma perspective. And boy, they're just boom, boom, right on, and got them, get the, check every quarter, which is nice. And then I just invested in another one in Irving. It's a bigger unit, 476 units. I was able to help to be a KP on that.
KP, what does that mean? Key principal?
Yeah, which means there's a certain number of folks that go through, and it's sort of like everybody's individual, what I'll call P&L, or their balance sheet, right? Everybody's balance sheet is then used to say, okay, to buy this unit, this apartment complex, do the folks signing, and which means I, sign to on that deal, as a principal, are responsible for that deal. Even though I'm really an investor, I'm pretty passive on that deal, but I use my balance sheet to try to help get that deal closed.
Sure. So you guys bought a property, you were part of a group that bought a property, the Fannie Mae loan, and they needed a certain net worth and liquidity requirement of the KPs or the key principals to qualify for the loan. Even though it's a non-recourse loan, this is what is signing on to commonly referred to as a bad boy carve-out, that if there's any sort of fraud or misrepresentation, you guys are standing behind it to make sure you're going to run the property ethically. And if there's anything unethical, that they can then, look to you guys to help support the property in the event of a default situation. So
correct. Yeah. And so I'm actually in the process right now of doing both, and what I mean by both is, again, looking for the right passive investment. So I'm pretty active in that. And right now I'm evaluating properties for kind of a similar deal. And what I'm looking for is, again, that 70 to 100 unit complex that, again, I'd like to have one where I can get a full-time office manager, full-time maintenance, bring property management, and run it very similar to my other one. So I am looking for that as well. And quite frankly, for me, a lot of this has been, diversification of my investments. And quite honestly, I've been working in real estate. It just seems to me over the last number of years, even though, the stock market has done very, very well, I continue to do very well there, I would rather get more money out of that and into real estate where I have sort of that passive income coming in, month in, month out. I think it's a much, much more stable investment.
So kind of going back, you said you signed on as a KP or key principal on the deal versus just, even though you're kind of passive in a passive role, just an investor. What is a benefit for you, or why did you want to be a KP on that deal versus just being an investor? What was your thought process there?
Well, they have two classes of how they will allocate, the profits, right? By taking that, what I call minuscule risk, but really putting your balance sheet in to help with the loan, you get a higher return. And that was very important to me. And quite frankly, I've met these folks, kind of the people that are investing. They've done phenomenal work in the past. They've helped me kind of understand and, just having conversations and talking to them. And if I can help by putting in my balance sheet to help them, it's great. I mean, I want to do that. And quite frankly, as a KP, it will help me as well, because then when I go for my next loan, it just shows that, hey, I have lots of real estate experience and, money in the game.
And sure, and this business is a lot about track record and my experience. So the bigger your resume, the better the track record. Then when you go to look to do your next deal, you potentially can look to have a Fannie Mae loan, which is non-recourse, versus when you bought the property in Hurstville, you had to have signed personal recourse on the deal. So,
And tell us a little bit of the structure of the loan that you have on Cavender Manor. It was a regional bank that did the transaction. Tell us a little bit about the terms and the structure and the rehab budget and what you found out after you closed.
Yeah, the bank's actually been very, very good to work with. It is a 25-year amortization. I had to put down 25 or 30%. It was 25% that I had to put down. It's 5 years.
So they let you roll the renovation costs into the total cost?
They did. We had pretty extensive rehab budget. I think it was right around $240,000. The best news on that was about 100 of that was for replacing the roofs. So what I did was I had somebody come in when we went through and did the inspection, gives me quotes for everything. So as soon as I closed on the property, I started to say, okay, now I want to start looking at, using this money. But I brought in seconds. I always wanted to get a second opinion, a second estimate, just to be prudent. And on the roof, they said, you know what? You have one roof that probably has some wind damage that you need to do something with. The others, there's really not a whole lot to do. So I'm like, wait a minute, I've got, $100,000 of budget here of a new roof that, was said. So what we did was we brought in a third party and said, let me get a third estimate. And they looked at it and they're the same way. Said, no, that you don't need to replace this roof. You have some damage that you need to replace.
And it wasn't leaking at all?
No, that was the thing. Even with the damage, and you could see one area where the damage, which was interesting, is it was right above really where the office was and everything. So we looked and, they went in there. There was no leakage anywhere. So I ended up, having to spend, I think, a little over $5,000 to fix the roof. And so now I have a big rehab budget. So we're trying to decide exactly where put the extra rehab. But what's been very nice is we've been able to go in and really help the interiors, primarily resurfacing the countertops, putting in a nice backsplash, new fixtures, fans and floors, and really be able to put those in fairly reasonable to where, the amount that we spend on that, we really will get back in about 14, 15 months. And we've been able to increase the rents to pay for those in 14, 15 months, which is kind of a no-brainer. So it's really worked out well.
How much are you spending on an interior turn, and what kind of rent bumps are you getting?
We're spending under $1,000. And we're getting really anywhere between $50 and $75 additional rent. I mean, some pretty incredible increases in the rent. And, the one thing that's probably I had a little bit more difficulty than I thought we would have, and that is with some of the tenants. Some of the tenants that we had in there, I will just say were not kind of the tenants that we wanted to continue with. So we did have a number of tenants where, honestly, this is, again, another great thing about having a property management company.
Yeah. I mean, I think it was your mentor that said the real estate's easy. The tenants are the problem or the hard part.
That's correct. But, it's one of those good news, bad news things. The good news is we're able to, and I think we're done. We don't have, it was kind of funny. We had what we called, after a couple months, problem tenants. We don't have any left. They're gone. We've been able to rehab the units that they were in and get new people in at much higher rent. So it's really worked out very well. And really the only what I'll call surprise that we had was with the roof. And that's a great surprise to have, less that we've had to spend. And then again, the property management company did a phenomenal job on their pro forma. So it's not perfect month to month, but if you look quarter to quarter, I mean, kind of what they said they thought we would be able to do, both expense and revenue, it's right in line. I mean, it's very, very well, very good.
Just like we were talking about, real estate's easy, and then tenants and people are tough. Any funny stories? Looking back through this past couple months since you've owned the property, and your number of units you've owned in your past. Any funny stories that you could kind of share with anybody that's interested in buying real estate?
Well, I kind of hit upon it. Really, the funniest thing was, I decided after working about 30 years and never taking more than 2 weeks off at a time, I decided, all right, I left the company I was working for. I said, I'm taking the summer off. I'm just, going to relax, have some fun with the kids and do all of that. And then this property, when I took the summer, started kind of looking at this stuff and really started taking it some serious. Near the end of the summer, said, okay, I met with the mentor, talked about what we wanted to do. And then I got a call from a friend of mine saying, hey, would you think about doing some consulting work? And it's like everything hit all at the same time. I'm like, wait, I want to enjoy the rest of the summer, but I had this property come up at, the very end. I had this consulting opportunity arise. At the same time, the 2 weeks before that happened, we left to go to Mexico for 10 days. So it's like, oh my goodness.
Wow. You have been very busy in putting together this opportunity over in Hearst. And Mike, any additional questions that you want to?
No, just any parting words of wisdom on to wrap up the podcast.
Yeah, I think the biggest thing for me was make sure you have kind of the right team, right? And it's interesting, I did buy this property myself, but I didn't do it by myself, right? Like I talked about, I had a real estate investor club that I worked with. I had a mentor that really helped me out. Obviously, working with Paul and going through and trying to, find the right loan, what worked was great, because I do believe when we first started looking at this, we were going to go with a Fannie loan. At that point in time, I had another investor that was going to help me, because he was going to help me actually get the Fannie loan. It wasn't a matter of, not having the capital to do it. It was more so having that experience with Fannie Mae. And what happened was the occupancy just for 1 month dropped under that 90%. So it kind of threw a monkey wrench in that. And I'm like, all right, well, shoot, I was kind of disappointed. Like, I'm gonna lose this, after doing all this work. Paul taught me, he goes, no, we'll get this financed. It won't be Fannie, but we'll do this. Kind of, I won't say talk me off the ledge, but, I thought I'd lost the deal. I mean, I just thought it was done. But, having the right folks to be able to help you when problems do arise helps. So I would say you have to have the right team.
Perfect. Well, Joe, we definitely appreciate your time. If someone wants to reach out to you, mind sharing your email?
My email is JOEJJOY. So Joe @yahoo.com.
Joe, appreciate your time. Thank you so much.
No problem.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.